We are certainly moving through peak tariff risk right now, and the markets are pricing some of that in. And I think that ultimately we will look forward to getting over this overhang. And I think that economic uncertainty certainly leads to market volatility, but we think that the tariff risk is just a temporary one. We're perhaps more worried about fiscal withdrawal in the U.S. That will have a much bigger impact on the U.S. economy, while other economies like China and Germany, they're expanding their fiscal stimulus there. So I think that that's more of an opportunistic place to look at.
And so are you saying that come April 2nd, the markets would not be volatile in response to the universal reciprocal tariffs that President Trump may impose? Because I do get your point. He is, for the lack of a better word, it's still not clear whether or not the full set of tariffs will come through. The band could be narrower. But even so, the threat remains, the concern remains, and the uncertainty looms.
Well, I think that I worry about tariffs if the uncertainty continues for a longer period of time. But we
How long you think?
For 3 or 6 more months. Okay. If we look at 2018, that was the tariff war part 1 was just a very short period of time. Markets were facing some pressure then, but then rallied pretty significantly. After the 12 months later, we expect the same thing to happen this time around. We don't expect the tariff risks to be a prolonged period.
Okay, Mandy.
Yeah, hi there, David. Mandy jumping in here. So why do you believe that these fiscal tectonic shifts, as you put it, are more important for an investor than the tariffs?
Well, I'd say that investors tend to reward markets when fundamentals are improving and when the economies are being reflated through stimulus, and that's what's going to happen in Germany and in China. The $1 trillion stimulus announced by German policymakers to take place over 5, perhaps 10 years, that should really provide a good boost to the economy and to also improve underlying fundamentals of growth in Germany. And also we're starting to see the stimulus measures that were inputted in China late last year to really have a much more muscled impact this year. Both the January and February economic data in China started to improve on all fronts, and especially on consumption, and that's what we're watching closely for the rest of this year.
Okay, so then on the flip side of that, if you say that the US is reducing its fiscal spending, would you not be investing in the US stock market, or would you be pulling money out of the US stock market?
I would be rotating some of the profits from U.S. equities to places like Europe and China. Emerging markets are also, quite cheaper than U.S. assets. And I think that there's just so many different opportunities now for investors to look at. It's not just the Mag 7 stocks. It's not just U.S. equities, but instead, there are other places. Indian equities have also been, feeling a bit of headwind. I think that that's also an interesting opportunity. Gold continues its trudge upwards, and I think that that's as an interesting opportunity to ward against geopolitical risk. So there are many different opportunities for investors right now.
Right. And before we take that break, David, what are your top strategies that you're advising clients?
We really like Chinese equities, and we think that it's going to broaden out to the A-share market from Chinese tech. I think that that's very much based on a lot of the improving fundamentals of the Chinese economy. We continue to like European equities, given some of the fiscal stimulus, and we also like real estate.